please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back, and let's hope this is a sound connection we now have with REC. Mr. P.V. Ramesh, the Chairman Managing Director, has been speaking with us. We were just trying to get a handle on whether you have already seen an increase in the cost of funds, what may be the increase in cost next year, and will that impact margins?
Now, as you know, I mean, it's difficult to predict these things, both in the domestic and the international market. I mean, all we know is REC, we are focused on raising resources at the most competitive rates. We have just raised $400 million denominated bonds in the international market at a very competitive rate to reprice our old loans. So we continue to do a mix of domestic, international borrowings, bonds, syndicated loans. So the whole purpose is to keep the cost of capital low so that we can finance power projects at the most competitive rates. So, I mean, going forwards, I mean, certainly we see some hardening, but, you know, the international environment is difficult to predict. So is also the national trends.
Okay. So what kind of margins can you see over the next 2 quarters? I mean, the first half has been quite poor. Your margins have fallen 80 basis points. What's the prognosis for the next 2 quarters?
Now, let me also say this. I mean, we still continue to be the most profitable NBFC or the financing or even among the banks. I mean, our NIMs are on the closer to 4 and our yields are more than 3%. So, I mean, which is among the highest in the league among the peers. So, yes, I mean, they have marginally declined compared to the previous years, but then that's natural. Comparing the overall ecosystem that exists, the liquidity, increased liquidity in the financial system. So all this put together, there had been some pressure on the NIM margins and the yields. However, that we are making that up with the volumes. Our sanctions have gone up 20%, and we are expecting our disbursement to go up by more than 10%.
Okay. What's been the loan quality, Mr. Ramesh?
And our loan book growth during the... Yeah,
please go ahead.
No. Go ahead.
No, I wanted to know about loan quality as well. Have things improved at all over there?
Now, I mean, coming to loan quality, things have not deteriorated. And as you know, the REC again has the lowest exposure in terms of the stressed assets, and especially the NPAs. I mean, it's less than net NPAs are less than 1.6%, and the gross is 2.54%. So overall, I mean, we've taken a number of measures. As far as we have set up a stressed assets unit, we have analyzed each of the projects. We have placed the project management consultants. We are working with the Joint Lenders Forum with the other partners, because in all these cases we have exposure along with the other financial institutions. We've already done change of management in 4 projects. We're in the process of effecting change of management in 6 other cases. We have applied the RBI prescriptions for salvaging some of these assets through S4A and 5/25 SDR. So we are very actively engaged to ensure the assets remain standard and then they perform, and they perform well. With regard to the state projects, they are on track as far as state financing is concerned. And 85% of our exposure is to the state and the central PSU sector. So it's about less than 15% of our total loan is to the private sector. And the stress really essentially is in the private IPPs.
Fair point. Thank you very much, Mr. Ramesh, for joining us with those details. And sorry about this sound problem. This does visit us once in a way. Well, that was REC. But, you know, let's now speak about interest rates and the banking sector in greater detail, about the best authorities on the quality of loans in banks and both private and public has been this gentleman, Ashish Gupta, Managing Director from Credit Suisse. I must, Ashish, take a minute to tell our viewers how much Ashish has contributed to the understanding of the quality of NPAs, both even to government and RBI. The first book, the first work from Credit Suisse on house of debt, I think came in 2012, if I'm not mistaken. That indicated the concentration of assets and bad assets at that in several public sector and private sector lenders, corporate lenders with the top 10 business houses. And from then on, of course, it's been an education of government authorities and regulators as well. And we have seen the asset quality review and other things pan out from the Reserve Bank. So the person we have now is extremely important to understand asset quality, to understand banking sector and the financial sector generally. Ashish Gupta, Managing Director, Investment Banking and Head of Financial Sector Coverage in Credit Suisse. Thank you very much, Ashish, for joining us. Okay, first up, the second list has also gone, the deadline ended yesterday.
Yes.
What is your sense of the provisioning that will be needed?
Sure.
Do you think, considering that most of them have gone to NCLT, banks are largely provided?
We actually are not yet fully aware that of the list of 28, 29 cases that RBI had, how many are actually going to the IBC. And of course, in terms of numbers, whatever reports we get, more than 20 are going. But I think from provisioning side, what is more important is in value terms. So are some of the larger companies going or not going? That is probably more important. And in terms of provisioning requirement, that actually is higher in the second list because many of the companies in the second list were newer NPAs, so banks had lower provisions to start off with. And therefore the incremental provision requirement, if all these second list of company goes, is about 0.5 to 1% of loans.
Of the total industry?
Yes, for individual banks.
Okay, so in the beginning of the year, you all had put out a report saying that with the aging of NPAs itself, 85,000 crore more of provisioning will have to be done by the banking sector. Now, what does your provisioning number stand at? I mean, I'm on the aggregate number. You said 0.5% of the total book to 1%. We find that arithmetic a little difficult. You tell us how much more provisioning will be needed.
See, that arithmetic has got complicated because some of the provisioning is getting upfronted. So if you look at the IBC cases, just because of aging, you might not have needed so much provisioning, but RBI mandated more upfront provisioning. But actually, I think at this point of time, what market should look at is not just provisioning what is needed in the next 6 months, but more look at what is the aggregate provisioning needed on the next 18 months, because we now have a fair bit of idea what is the total pool of stress assets that are out there in the system. And for the first time, we are getting some sense what is the loss given default or haircut these will mandate. So yesterday was also, or day before was the last date for getting bids on Monet. So as those details come out, I think banks will have a fair bit of idea on what is the extent of provisioning that is needed on the entire pool of stress assets and where they are currently. And our estimate is that banks at aggregate today only have about 40 to 43% provision cover, but what they need is about 65 to 70% provision cover over the next 18 months. And that's why the capital that is being provided by the government comes in handy.
Okay, so that's interesting. Only 42 to 43% provision cover currently. Ashish, hi, good morning.
Good morning.
Have the bad loans in the banks moderated in the last, say, 2 to 3 months? And also with more cases now falling under the NCLT, when do you expect to see a peak as far as the NPA cycle is concerned?
So I think we should differentiate between the bad loan and the impaired loans and NPAs. So as per our aggregation, today the NPAs in the banking system is about 8 lakh crores or about 10% of loans. But the total impaired loans is about 13 lakh crores or about 16%, right? So there are a lot of loans sitting in restructured, watch list, SDR, etc. And these are the pieces which we believe will probably flow into NPA over the next 12 to 18 months. So in that sense, the NPA number will continue to trend up. But we are actually more hopeful that the aggregate bad loan number at that 13 lakh crore is close to peak. Okay. So if you work out on base of provision requirement based on that number, I think we should hopefully not get too much negative surprise.
Ashish, good morning. So in that case, how to approach the PSU banks? Because you know we had a big rally after that recapitalization.
Yes.
Half of those gains have been given up.
Yes.
How to approach this space now?
Sure. So I think one thing we clearly have to wait for is the details of the recap plan. But our strategy within PSUs has been to look at banks that have stronger core operating profitability. Right. Within the PSUs, I think one part that is well appreciated is the extent of impaired assets they have on their book. But I think an equally important part is how the core operating profitability is. And some of them, the core operating profitability is fairly weak. And therefore, the concern is even when you provide for this NPA, even after you get the capital, how much profit they can generate, what ROE you can generate. However, there are 3-4 PSU banks that have good core operating profitability, and we believe for the investors who have a 1 to 2 year investment horizon and can tide through this period where there is this uncertainty of when the recap will come, and of course there will be a big dilution, but after that as this bad loan mess gets cleared off their book, you get to a scenario where they start trading based on their core profitability.
Your compliance allows you to name those? I mean, they might be published reports.
No, yeah, so we can't name those, but they are in our reports.
My sense is SBI would be there in that list, but okay. What about, let me come to the bigger theme which we want you to address, NBFCs.
Yes.
Now that we have seen yields going to 7.2, and of course the non-10-year yields have even gone to 7.4.
Yes.
Are you trimming NBFC positions? And if you are, what are you replacing them with?
Sure. So we took some weight off the NBFCs and we added PSU banks at the time of the recap. Okay. What we, however, still believe is that not all NBFCs, the business case goes away just because yields have gone higher. The fact is many of the NBFCs are strong asset franchise. They have very strong niche businesses. Someone is good in gold financing, someone is good in rural financing, someone does truck financing very well, and those are competitive advantages that continue, right? Of course, there is some tempering of expectations of margin expansion because the funding cost, etc., has gone higher. But I think for those NBFCs that can sustain their growth rates, we are still positive on.
Okay, but will you give them 8 times like some very good NBFCs got? Or
yes, so valuations is a concern. So we have trimmed weights on the NBFCs where we felt either the valuations are excessive or the relative risk on margins is higher. And the framework there is those NBFCs that are doing more plain vanilla lending, say just salaried mortgages, or are more dependent on bond market for the funding. So those will see a larger pressure on their profitability.
Okay, so that's on NBFCs. But just coming back to the overall picture, you told us about how the impaired loan situation could be at a peak now.
Yes.
What about credit growth? I mean, are you noticing any signs of improvement as far as credit offtake is concerned?
Yes. So there, I think the situation is not as bleak as generally borne out. I think the 5% credit growth that we had last year had several one-offs as well, right? And I think with the kind of nominal GDP growth that we have in double digit, it should not be too difficult to get a double-digit credit growth, right? Last year we had several other factors impacting credit growth. Some credit growth went to the bond market because there was excess liquidity and bond yields were low. Now we are seeing reversal of that, and therefore some credit growth to the banks will come back from the bond market. You also had those 3 months of demonetization where credit growth was actually negative. So, so as that normalized. So if you look at sequential trend in credit growth this year, that indicates that by first quarter of next year, you will be in double-digit credit growth.
Okay. Generally, Ashish, what is the sense about growth in the economy itself? I mean, through the finance sector, obviously, you're a proxy for measuring even growth.
Yes.
Can we be confident that things will pick up, the GST disruption will be behind us, and to the FY19, the growth numbers are going to be much better than...
Sure. No, so clearly the outlook is positive for next year. There is a pickup from the slowdown we saw in the last 6 months. But of course, it's a mixed bag, right? You still don't see the investment side, new project announcements that really picking up. But on the consumption side, services side, trade side, I think things are fairly good. Exports is one area, particularly manufactured exports, that has been a disappointment. But services exports, tourism, those are actually still doing better.
Corporate banks, retail banks, what's your preference?
So we actually now have a mix of both corporate and retail. We are not so exclusively concentrated on the retail banks. I think in our topics there's a mix of both corporate and retail banks. In retail banks as well, there are some names we don't like where we think valuations are excessive and growth is not supportive of valuations. I think the key will be pockets where there is growth, whether it's corporate banks, retail banks, NBFCs, they will continue to do better.
Okay, Ashish, it's a pleasure having you with us. And
thank you for having me.
Thank you very much for joining us and giving us your views on how financial sector is headed. Well, I think it's almost 10 and we have to take technical views.
Yeah, we have to, because it's been quite volatile, the market that is, and the Bank Nifty went to the lows, has recovered. The Nifty is in the green, the Sensex almost there, the mid-cap index in the green. Ashwini Gujral, Mitesh Thakkar and Rajat Bose with us. Ashwini, your initial trade worked out. What next? There are a couple of stocks which are moving to high point like Infosys, but select banks are weak. How would you approach the rest of the day?
See, generally the biggest money is made in the first half an hour. On a day like today, if you made money in the first half an hour, the right idea is to not mess around now, because the moves will keep on getting narrower and narrower as you go into the close. If you still have to do something, I think Walkhart is picking up. So that looks like, some amount of bottom maybe getting created on Walkhart, at least a rally for the day. Also, as of right now, Godrej Industries seems to be moving off its 200-day moving average. As far as calls right now are concerned, Voltas a sell with a stop of 620, target of 595. ONGC is a sell with a stop of 188, target of 176. And Godrej Industries a buy with a stop of 590, target of 615.
Congratulations. Okay, well, thanks, Ashwini. Mitesh, what are you trading?
So in fact, I was just hearing to the RSE management, but the stock price chart in the short term is negatively biased. I would sell with a stop at 151 for targets of 135, and BPCL is a buy about 512, keep a stop at 507, more of an intraday trade, and look for a 522 kind of a target.
Okay, Mitesh, thanks for that. And Rajat, over to you. Good morning. What would you be looking at trading this morning?
I'll trade 3 counters and all 3 are a buy. Take Mahindra, I would say that you put a stop loss below 509, targets would be 523 and 529. Take Mahindra has given a range breakout and also open interest build-up is happening there. TVS Motors is another stock, 741.80 is my stop loss, 750 and 753 intraday targets. And finally Balkrishna Industries, I would say you buy in the December futures, put a stop below 24.30, 25.11 and 25.37 are the 2 targets. If needed, carry this position forward, and also the disclosure that I personally hold Balkrishna Industries shares in my portfolio.
Okay, it's a big move actually on Godrej group stocks, Godrej Industries that Ashwini spoke about. Ashwini, so your buy is on Godrej, but what about the other Godrej group stocks? Godrej Properties has also looked strong over the last few days.
See, mid-cap real estate is a theme by itself, so maybe Godrej name may not be needed there. But overall, I think all of these stocks, Godrej Consumer, Industries, etc., they've been hanging around their 200-day averages post, a large correction. So it's time for them to turn around. So anybody who wants like a low-risk idea in terms of volatility can get into these Godrej Consumer and Industries type of stock.
If I'm not mistaken, I think Mitesh also referred to Godrej in early trades. That's something that all the technical experts are looking at. Thank you, gentlemen, for joining us again with your 10 a.m. trades. We'll touch base with you oftener today, considering that it's going to be a difficult day of trade. And with that, next corporate guest.
Yes, in fact, let's talk fitness, right? Talwalkar's posted a strong set of earnings in Q2. The management says they saw significant momentum in Q2 due to the annual August scheme. Anand Gawande, CFO and whole-time director of Talwalkar's, joins us as always. Anand, good speaking with you. Great quarter once again, but take us through how the quarter has been. What were the total number of member additions that you saw, and do you expect the traction to continue?
Actually, if I look at what happened last quarter, Sonia, June was a subdued quarter. Essentially, the GST was about to get implemented, and June is not a great quarter. So our year-to-year growth in June was not up to our mark. So there's a lot of pent-up demand post 31st July, because even GST got over. We got clarity on where we stand, and we have been one of the net beneficiaries of the GST scheme, because we get to set off GST against our purchase of imported goods. So 1st August, as usual, we launched our scheme, and this time a small twist in the tail was we launched a scheme with all in, which means you pay 1 lakh and you can go anywhere in the gym, any amount of times a day, use yoga, Zumba, Zorba, weight loss, personal management, anything which you want. Though it was a small start, it was a great start there. And I think there was definitely a pent-up demand on it. Also, last year there were certain costs which we had incurred, which we did not have to incur this year, like opening of new gyms, etc. So overall, the top line growth came in at 10. Same store sales growth may be a little lower than that, about 6, which is satisfactory. I think going ahead, if things improve, I'm pretty sure we will do better. And we were then aided across the board actually by what happened.
Anand, good morning.
So, good morning.
In that case, can we extrapolate this kind of growth numbers for the next 3 or 4 quarters?
Generally, December is a subdued quarter, but we think that we will be able to do a lot of vast value-added services in December because people do take holidays. The holiday season will start in real earnest now. Jan, Feb, March, we are hoping to open between 20 and 30 gyms of variety of kinds. Now, if we do that on spot, then I think there will be a lot of momentum in the 4th quarter of the current year. I'm fairly sure of it.
Okay. Well, Anant, your profit growth is very impressive, as of course is your margin. One can't see that of your revenues. So give us a guidance on all this. Can you maintain margin, keep improving your margins at 61.5%?
No, actually the margin contains a component of the other income. If you take that, I mean, if you look at the results, there is other income and there's main income.
Okay. So
the margins are up about 80 bips or 80 basis points, which is good enough. I'm not denying that is not good. Also, what aids the 2nd quarter is no new gyms open. So no additional charge on depreciation takes place. So the 4th quarter that will take place. But overall, if you ask me, do I believe that this kind of profit growth is possible? I think it is possible. Our focus actually more, Lata, Sonia and Anuj, is on how can we get more momentum out of the same gym, if you remember. So we are now the #1 among the biggest yoga chains in India. In 15 years, we have gone from less than 10 gyms to almost 250 gyms. We are among probably the biggest player in weight loss in India. So slowly we have built up smaller units, which are very, very important and which could actually create enormous value going ahead.
You've also tied up with Mickey Mehta, right?
That is right.
But he has his own set of gyms.
That all comes into this. That all come into this.
Okay.
So Mickey Mehta 360-degree wellness, which is his famous thing, which has about 15 or 17 studios, move in here. And we also start Mickey Mehta in between 30 and 50 outlets over the next 2 to 4 quarters within our gyms or outside our gyms.
So what's the revenue arrangement like?
No, it's a 50-50 joint venture,
50-50.
Sonia.
Okay.
So this is exactly like Zorba.
Okay. No, is this, can we go with this 10, 15, 25? 10 revenues, 15 EBITDA, 25 net.
No, if you have to do 15 and 25, then you have to have 12 to 14 revenue.
Will you have that?
I think we should be able to have that. I don't see that as a difficulty because, as I said, there was a marginal dip because of two disruptive events, demonetization and GST. Both, I think, are well behind us. Okay. And with that going behind us, I think growth is back for people and companies like ours.
Okay. Anand Gavande, it's always a pleasure speaking with you.
Always a pleasure to talk to you.
Feel fit even speaking to you. Thank you very much.